Good evening and welcome to the CNBC TV 18 special broadcast. As we told you, it is now official. The government has announced a massive boost for the banking sector by approving a 2.11 lakh crore bank recap plan. This includes 1.35 lakh crore rupees via a bank recap bond. Remember, this is what we've been telling you that was an idea that had gathered momentum and currency within the finance ministry, and it's now been taken forward by that official confirmation that's come in this afternoon. 76,000 crore rupees from budgetary support and market loans. Finance Minister Arun Jaitley has also announced that more measures will be taken in the next few months pertaining to banking sector reforms. Let's first hear out the Finance Minister, the Economic Advisor Arvind Subramaniam and the Banking Secretary, and then we will decode what this recap plan means for the economy and for the banking sector.
अब पब्लिक सेक्टर बैंक्स के पास लेंडिंग करने के लिए साधन खूब हैं। विशेष रूप से डीमोनेटाइजेशन के बाद जो साधन बैंकों के अंदर डिपॉजिट किए गए वो सब आज अवेलेबल हैं, उपलब्ध हैं लेंडिंग के लिए। लेकिन पैसा है उसका ये अर्थ नहीं कि वो लेंड हो सकता है। इसलिए आज मंत्रिपरिषद की बैठक में इस डिटेल्ड प्रेजेंटेशन के बाद यह तय हुआ कि सरकार को एक बड़ा कदम, अ बोल्ड स्टेप शुड बी टेकन बाय द गवर्नमेंट टू एड्रेस दिस प्रॉब्लम। इसके साथ साथ बैंकिंग रिफॉर्म्स भी होंगे। नाउ व्हाट हैपन्स टू द बॉन्ड्स is a separate question. It will depend on the nature of the bonds itself. That we will be clarifying in due course once the bonds are issued. Once you strengthen the banks under the scheme which we have announced today, certainly the attraction for the banking stocks also is going to improve.
There is a differential approach which one would follow. We'll see the performance and the potential of each bank. That is number one. And secondly, there is sufficient valuation upturn in the valuation which we see in those banks because of the better capitalization and the credit offtake they will start. And next, as FM also mentioned, that there has to be a system and a mechanism where it's a prudent lending. Term and tenor of these bonds, as the Honorable FM mentioned, will be decided and the DA will decide. The bonds will be front-loaded. This I am saying twice.
Over the next
front-load means essentially within next 4 quarters. But as FM mentioned, this will be decided and definitely it's a max to max 2 years roadmap.
It's true that there will be more demand on savings because there's more, issuance of all these things will absorb savings. I think the key thing is that under normal circumstances, more government borrowing crowds out the private sector. Right. But here, precisely because this investment is meant to unjam the whole financial system, the confidence that it can generate could in fact work towards, creating confidence and actually crowding in private investment. But let's see how it works. But that's so it's not on. You're right to ask the question that more, funding like this could crowd out other forms of spending and investment. But it depends upon what it's being used for, and because it's being used to address a critical bottleneck now that we believe is holding back growth, this can have a very salutary effect.
Well, the government unveiling several measures today. The cabinet essentially clearing 2 big-ticket items, one pertaining to infrastructure, which has to do with the road building program, 6.92 lakh crore rupees over the next 5 years, and the other, of course, has to do with the PSB recap plan. Let's now go across to Latha to talk about the recap plan. Latha, let's make sense of what this recap plan entails. The details on how it will finally be issued, etc., is still awaited. The government has not revealed those details just yet. But on the back of the information that we do have, and historically the way that it's worked, what will the bank recap bond do? What does it mean for the banking sector? And eventually, what is it going to mean as far as the economy is concerned?
Okay, well, first, how it worked between 1985 and 1995 was as follows. The government sells these bonds, and they are very long-dated bonds, 10, 15, 20-year bonds, to the banks. The banks buy it out of their deposit money, which they would normally have lent. So, 1.35 lakh crore spread over, some 11 or 12 or 15 banks will not be a great deal of money per bank. They would be probably shelling out 10,000, 15,000 crore per bank. Now, government takes that money and gives it back to the bank in the form of equity capital. So basically, it's clean tier 1 capital that comes to the banks. So banks are recapitalized. The only thing is, this is a bond which the government is selling. So whether it will come as fiscal deficit is the worry. Now, in many countries, when they are under stress, under duress, like the Asian countries during the Asian crisis, have resorted to recap bonds. We resorted to oil bonds when oil prices shot up. We resorted to fertilizer bonds in certain periods. So, and of course, we have done recap bonds as well. And all these were not part of the fiscal deficit in those years. So the expectation is that we will be able to explain that this 1.35 lakh crore is not part of fiscal deficit. But this is how basically it operated in the last avatar. What does it do to banks? It's more than enough. The expectation is 1.35 lakh crore plus another 75,000 crore, which will come partly through budgetary support. 18,000 crore is budgetary support, and partly through public raising, equity capital raising by the banks. Now, it is a certainty that when they are well capitalized, banks go and raise money, they are going to be able to get it at a very good valuation. At the moment, share prices are trading at 0.3 and 0.4% to book. The moment this recapitalization is announced, you must expect, as it is, you saw a monster rally of PSU bank shares today. That rally will continue, and therefore banks will be able to raise capital at probably one-time book, which will be a very good thing if they're able to get that price. So the point is the capitalization problem will be resolved. Now, how do we arrive at this 2.1 lakh crore as the requirement? Already there are loan losses of about 25,000 crore. Plus add to it growth capital, assuming a 10% growth in 2 years on a base of 60 lakh crore, banks will be able to, the loan growth will be 12 lakh crore over 2 years, for which they will need 1 lakh crore of growth capital. So that would explain about 1.25 lakh crore. Plus they have to make provisioning for bad debt, which is about 1 lakh crore. So a total of 2.2 lakh crore is what was always needed for the banks over the next 2 years for growth, for provisioning, and for loan losses. So the arithmetic is perfect. You can't quarrel with this arithmetic. My sense is that the markets and the PSU shares are going to rejoice tomorrow. Maybe there'll be a bit of sulk from the NBFC companies. They had a field day in terms of lending. Now they get real competition from the PSU banks.
All right, Lata, appreciate you joining us and explaining to us what the bank recap plan means, what the bank recap bonds will do for the banking sector. But let's also go across to our colleague Sapna Das. She's been tracking all the action. Sapna, let's talk about that 75,000 crores, and 18,000 crores is the budgetary support from that 75,000 crores. What is the sense that you get? Are we likely to see the government provide any more capital, or is it going to be left to the banks to raise capital from the markets?
I think the sense here very clearly is that the recap bonds, coupled with the banks raising money from the markets, that's what the action plan looks like as of now. We had tried asking this question in the press conference. And the response that we got very clearly was that since 2.11 lakh crores has been spread out over the next 2 years, it remains to be seen. And in fact, the finance secretary did say that it will depend on what kind of a recapitalization plan we are able to adopt for the banks. So the sense here is, and this is something the banking secretary has tried to clarify in not so many words, but yes, in a sense, that it is going to be the recap bonds as well as the banks raising money from the markets on their own, which is going to take care of the major requirement, the fund requirement. So the sense here, as of now, at least, is that there is no additional money that's going to come in from the government's exchequer in terms of propping up the health of the banks. And yes, as Lata was rightly pointing out, once the announcement of the recap bonds have been announced, I mean, once that takes place, and the secretary has very clearly indicated to us, he has said that it's going to be front-loaded, it's going to happen in the next 4 quarters, which means 25 to 30 odd thousand crores probably every quarter, or some kind of that expectation we can have in terms of the quantum of how much they're going to raise. Once that happens, then banks may be in a better position to raise money on their own from the markets.
All right, Sapna, I appreciate you joining us with that. But we've been speaking with a whole host of experts. So let's start decoding what this means now. Usha Thorat, former Deputy Governor of the Reserve Bank of India, and Ashima Goyal, member of the Prime Minister's Economic Advisory Council, both believe that the recapitalization plan is a decisive move by the government. Goyal says the market had been waiting for such a move for a while, and Usha Thorat believes that this will provide the much-needed fillip.
Mrs. Thorat, recap bonds, 1.35 lakh crore front-loaded, another 76,000 crore to be raised by market or from the budget. How do you think this is going to work, ma'am?
First of all, Lata, I think it's a very good and very decisive move because in a sense, this is what the entire market has been looking for. Now, obviously, there are many issues with the banks. Again, you know, what will happen? You're putting it into the banks, which are the PCA banks, and supposing all this goes good money after bad, and that's really the most important thing to see in the way forward. But I think you're more concerned, your question is more on the design of these bonds. These recap bonds are, like you said, they are a direct infusion into the banks. And because the banks don't need liquidity, they don't get the capital in cash. So therefore, they will hold it in the form of investments in their books. The government will issue the bonds and the banks will hold these as assets, and that to that extent will be added to their capital. Because these are actually now income generating. It's going to return interest to them because to the extent of the bonds that are given to them. So that way it is really capital. Now the fiscal implication of this is that it increases the debt to GDP ratio and the interest on these bonds will be a drain on the budget. So over and above the whatever is expected out of that 76,000 crores, what I recall the finance minister saying was 18,000 crores is a budgetary provision.
Yes, that's already done.
And the balance of it is really the banks are expected to raise from the market. Now, that's the critical thing.
No, but ma'am, with this kind of an equity front, you know, clearly the word front-loading has been mentioned with respect to the recap bonds.
I mean, I think
if you front-load, they will be able to raise equity, you think?
No. It only means that you will give the equity in the form of bonds, Lata.
Yes.
So there's no front-loading, back-loading. That means the banks will be given, government will issue debt to that extent and put it in the banks.
Yes.
Now, the way that debt is going to be priced, what will be the equivalent benchmarks and all that is a different question.
Yes. No, my point is that when you have this kind of, maybe via debt, but it is a well-capitalized bank, and if this kind of a bank goes to raise equity from the market, you will get it at a better price than
Obviously,
the current...
that is the whole design of this. When this kind of a bank goes to raise capital, it will definitely get it at a better... I mean, rather than the way they are trading now, price to book and all that, such very low levels.
Yes.
So even after the cleaned up balance sheet, where the market has now much better perception that this is a true and fair picture. Is there anything worse to come? Is always a question that the banks, I mean, the public and investors keep on asking. But by and large, I would say that having done the extra provisioning and all the asset quality review, so I would say this was a logical step the market was awaiting.
You know, there doesn't seem to be clarity on how this is going to be accounted for. The finance minister said that we will decide that in due course. He did seem to suggest that internationally the standard is different, and domestically, so far, historically, we've dealt with this differently. In terms of whether this is likely to have an impact on the fiscal deficit or not, and how it will be accounted for, what has been the practice so far, ma'am, and what do you believe is likely to be the case going forward? Because that, I believe, is still a matter under deliberation.
Right. I think they have announced this, but they will go into the details. So they could be raising money in other ways. They could be, because one concern, this does not add demand, even if it adds to the fiscal deficit, because it is recapitalizing the banks. But in terms of the supply of bonds in the market, here, if the market believes that this is being used in a way that removes a major stress in the Indian economy, it's unlikely to really raise the GSEC rates, right?
Okay.
So which is a major concern.
Yeah.
This is coming after a period of reform in banks, especially the thing about imposing deadline, because the most urgent for the economy is that credit should restart. So we are seeing some rise in demand now, and this will increase the capacity with banks to lend. And at the same time, I think the allocation of these bonds to banks should follow which banks have been most, have done one-time settlement or have resolved assets or restarted lending. That should be the criterion used so that it motivates banks to resolve these matters quickly and to get credit restarted.
Okay.
Well, that's a member of the Prime Minister's Economic Advisory Council, Ashima Goyal, and the Banking Secretary did say that performance and potential, that's broadly going to guide the way that capital is infused into the public sector banks. There will be a differential approach. That is the categorical assertion, but how it will eventually pan out, those details are still awaited. Well, we also caught up with the former Deputy Governor of the RBI, KC Chakrabarti, as well as the MD of the UTI Asset Management Company, Leo Puri, and both believe that this is a decisive move. It's a positive, welcome move, but it must see follow-through action in terms of other reforms pertaining to the banking sector.
So you have seen one period of recap bonds in the mid-90s. What the government has announced today is a 2.1 lakh crore capital infusion, of which 1.35 lakh crore will be front-loaded in the form of recap bonds. Your reaction, sir? Way to go?
You see, look, recap bond means who will pay interest? It is interest-free or what?
Well, we don't know that yet, but my sense is...
Anything which is a debt, that is not capital, really. Capital must have the characteristic of absorbing the loss, and it must be cost-free. So still the banks are making profit. So that's the one thing. So anyhow, but this is a good step. You see, partly it will improve, but all what I want to say, the capital requirement, that is equity capital requirement of the banks is much, much higher. And if you don't do it in the full form, it is not going to give the result.
But this is shareholder capital. This is shareholder capital, isn't it? At least...
I don't know if it is... that is what... how a debt instrument can be capital shareholder.
No, sir, that is how... But didn't we do that in the mid-90s? What we did in the mid-90s was the government sold those recap bonds to public sector banks. Public sector banks bought those bonds. Yes. And with that money, government capitalized the banks, right?
You see, look, all what I am saying that debt is not the capital. Ultimately, government written off those amounts. If you remember, the government has written off those amounts.
They wrote off or they converted it into equity.
So this is in what form, who will giving that, leave aside, this is a good step, you are strengthening.
Yes.
But the requirement of the banks is much more higher and most important. If you are not making the reform in the banking structure processes, this capital will be wasted.
Yes.
Now, capitalization will be subject to that condition. You got my point now? You give capital to everybody. But the question comes that if you don't reform, if you don't improve the corporate governance, if you don't bring the accountability, since this capital, this is the taxpayers' money will go into the same thing.
Leo Puri, the Managing Director of UTI AMC, has joined us, and he's a veteran who has seen the previous avatar of recap bonds. Mr. Puri, I think you heard most of the details. What's your first comment? Way to go. I think you said this at an interview with me just 24 hours ago, that recap bonds is the way to go.
Yes, that was a coincidence. So clearly it's something that I welcome a lot, and I think most market observers will welcome the decisive decision and the comprehensive way in which the proposal has been made. Obviously, there are a lot of questions, as you've just been discussing. I caught part of that. And I think there's a lot of ambiguity around the accounting and so on.
Yes.
At this point, my take is that one way or the other, this is going to cause concern as regards the fiscal deficit. However, whatever the accounting treatment will be, but that's not really going to be the core issue, because fundamentally, if the quality of the spending is good, and if indeed there's enough thought that's been put into the manner in which the recap will actually help stronger, better equipped banks to emerge, then there will be a fair amount of forbearance on the part of international investors, bond investors in particular, towards that. And there's lots of experience internationally where good quality spending for purposes that essentially drive economic growth are welcomed by bond investors. We don't yet have enough details, but the benefit of the doubt for the moment we can give. And we know what we would need to look for, which is This should not be good money after bad. This should not be viewed as a wasted opportunity where merely having waited for 1.5 years, trying to cajole the banks into reform, we are seen as throwing in the towel now and simply doing a blanket recapitalization of all banks because we're running out of ideas on how to create economic growth.
Yeah.
Because let's say as an investor, wearing an investor's hat, we now have a recapitalized but continually badly governed public sector bank. It's still not going to be able to compete and drive future revenues. So why would I invest given the alternatives I have?
Well, I think Leo Puri there echoing what almost every single panelist of ours has said, that this should not become an exercise of throwing good money after bad. It should see a follow-through action in terms of the tough reforms that are expected. Of course, no word in on the consolidation plan. Remember, that seems to have been put on the back burner, at least for now. But Lata, back to you. You know, we've talked about what could happen as far as the equity markets are concerned, but let's talk about the possible impact and the reaction from the bond markets.
Well, my fear is the bond markets will look askance at it because there is an increase in government debt. They will be a little worried about the exact clarity on the nature of the bond and whether in any form it will be traded. My sense is it's not going to be traded. It will be a held-to-maturity bond with the banks. But to that extent, banks in the immediate run may not be buying bonds. So there will be some impact on the bond markets as well. They will want to get the last word from the rating agencies. If the rating agencies are not entirely convinced that this is not fiscal deficit, there could be a rating impact as well. So bond markets are not going to be leaping in joy as the equity markets will, because this is a growth-oriented step. Separately, I want to also add that the compulsory listing of public sector units on the Trades Exchange will be seen very positively by the equity markets, because the sheer movement of capital and funds, liquidity, has stopped today because of the GST. Not very sure whether the input tax credit will come. A lot of, the biggest companies, the Larsons, the Power Grids, the NTPCs are not paying their MSME suppliers or any supplier for that matter. If this kind of listing of public sector units in the Trades Exchange becomes a reality, apparently I think there's 90 days time given, then the chances of liquidity returning to the MSME sector will be very high, and that also will be a big growth booster. My sense is tomorrow it's hugely equity positive, bonds question mark.
Well, speaking of the bonds question mark that Lata just alluded to, here's Anant Narayan of Standard Chartered, also Moody's Investor Services, Shrikant Vadlamani on the likely reaction.
I guess it's a very, very welcome news. The reality is this is the first time the government is accepting that there's a big hole in the capitalization of banks. The number is fairly close to what we've all been saying is the actual nature of the problem. So taking the bull by the horns, acknowledging the problem and putting aside the money for it, I think it's a fantastic start. Second, I think we've all agreed, and I read your piece in Mint, by the way, I think we've all agreed that the best way probably of managing this the capitalization is through the recap bonds.
Yes.
That makes it cash neutral. It doesn't become, directly fiscal deficit sensitive. It essentially is an accounting entry in many ways, right? You're essentially, boosting the capital of the banks, the liability side, and on the asset side, instead of giving them cash, you're effectively giving them a piece of paper. While it might sound like an accounting entry, the reality is it's much more than that. Today, banks are holding far more bonds than is required as per SLR or LCR, purely because there is excess liquidity in the system. So as long as there's excess liquidity in the system, this shouldn't have a direct impact. At the same time, one cannot deny the fact that there is this extra stock of bonds which is lying in the books of the bank, and these will be long tenor bonds.
No, I'm also, Anand, to that extent, I thought the way in which the mechanism is, banks will be using their money to buy the recap bonds from the government, and government will use that cash to recapitalize the banks. To that extent, they will have less loose cash sitting with them. I mean, tomorrow, how will the Government of India bonds open?
Look, it could open a little on the softer side while the market still settles down. But to start with, there is no real outflow happening anyway. It's an accounting entry. You're right. Money is going from banks to buy the bonds to the government.
Yeah.
But the same money comes back to them as capital.
As equity,
so it's cash neutral, as equity.
Srikanth, first to you. It looks like a 2.11 lakh crore of capitalization. What does this do to the rating of bonds of these public sector banks?
Well, I think it addresses the capital issues. I mean, obviously, we need to wait to see which bank receives what, and that's what would impact a specific bank's rating. But the headline number is definitely a very significant positive as far as the capital needs of the public sector banks is concerned. We had estimated that the 11 rated banks that we rate would require close to around $15 billion. That works to around 1 lakh crores, and this number is obviously significantly above that. And I think the number we need to work with is actually the 1.35 lakh crores, because I think the incremental beyond that is probably contingent upon the ability to raise the access to markets. But even 1.35 lakh crores is a very significant positive. So.
But, I mean, this obviously, you are the financial services guy, financial institutions guy. What would your sovereign rating guy say? Will he be okay and accept the argument that this is below the line and not fiscal deficit?
Well, Lata, I think the announcement has just come out, and I think the sovereign analyst is the right person to talk about it. Sure, I think in the order of magnitude, clearly, I think from a bank's perspective, the recapitalization is of the prime importance here, in my view, and I think the extent of the money, the extent of the amount that the government has announced really leaves, I think, little uncertainty on how banks will be able to fulfill their capital needs. So in that sense, it really addresses right and center the capital needs, and to me, that is the key positive from this announcement.
Well, there you go. We've tried to get you reactions from every constituency, from former RBI deputy governors to explain how this could work, to the equity market reaction, the bond market reaction, and of course explain to our viewers how the recap bond as well as this recap plan could impact the banking system. We're still short on detail, by the way, because the Finance Ministry has made it clear that while the Cabinet has approved this headline number, which is 2.11 lakh crores, the nitty-gritties are yet to be worked out. Those details are still awaited, but keep it here on CNBC TV 18. We will continue to focus on this big story and more. From all of us here for now, thanks very much for watching.